Hello, everybody. We're going to get started here. This is being live streamed both on YouTube and X. And we're going to review Rivian's Q3 2024 results. And now we're going to join the earnings call, just like we would be doing it live. But it's going to be, we're going to listen to the recording, obviously, and now we're going to discuss. So if you want to join the party, hop in on YouTube. You can join us in the live chat. And this is a link in my post on my profile. And then I'm not going to be seeing the replies below the X account, I don't think, today. So you can ask questions, share your views as things are happening, and we can take it from there. So, Jacob, how are you? Hustle Town?
Going pretty good. Can't complain. Love the show earlier today. Representative from, where was he from?
South Dakota. House of Representatives in South Dakota. I think he said sixth district.
Yeah, I was going to ask a question, but it was probably going to be like, should South and North Dakota be merged? And I don't think he'd have appreciated that.
Yeah, maybe. I've actually met him in person before.
That's awesome. He seems like a really good guy.
Yeah. Tesla Owners Club in Austin had an event at a steakhouse at a barbecue place in Austin before a Tesla event. And he was there with, I met like hundreds of people that day. Yeah. Anyway.
I need to do more events.
Yeah, I highly recommend it. Even if you don't get accepted to the, invited to the event itself, it's always good to head over there because there's always like events before and after, and you just meet a lot of people. And once you put a face on the voice, and you kind of have a drink with them, whatever, your online interaction with them also improves quite a bit.
All right.
Okay.
Take that advice.
All right. So here is Rivian's results. Okay. So I think people can see this on their screens. I can zoom in a little bit without covering us. So there we go. Let's scroll through this deck just like we do for the Tesla earnings. And this happened. Rivian announced the results this week. So this is pretty fresh data here. Key highlights, reaffirmed outlook for 50,500 to 52,000 vehicles. So reaffirmed delivery outlook. Can you see my mouse tracking on the screen?
Oh, yeah. That's not terrible.
All right. Reaffirmed in 24 delivery outlook, on track for positive gross profit in the fourth quarter. So this is kind of the... this is the thing that people really focus on. I would be shocked if they achieve this, but even if they do, I think they have a long road ahead to sustainable profitability, because gross profit is obviously before operating expense like R&D or SG&A. So, Tesla achieved operating profitability 2-3 quarters into Model S ramp, and gross profitability just 1 quarter into Model S ramp back in 2012. So, Rivian hasn't been able to do that over the last 5 years. So it's important to understand the difference between gross profit and operating profit and net profit. Okay. 20 increase in demo drives. Okay. Launch R1 tri-motor configuration with 2.9 second range up to 405 miles. Okay. Majority of customers subscribe to Connect Plus following the free trial period. Okay. So let's keep an eye out for what is the price for Connect Plus. If anybody knows, please leave in the live chat. So I see live chat already. Matt Senko says, not invested, but curious how you guys think. You are being judged. Okay. Geo Guy 85. Yes, race between making money running out of cash. Okay, no clue. 8th like. Yeah, hit the like button and repost and share the video with your followers. It really helps us grow. And every like helps. So please take a moment to do that. And let me know your code check number in the live chat. R2 sourcing. R2 sourcing in line with targets, 85% of bill of materials sourced to date. Interesting. Okay. During the third quarter of 2024, we made progress advancing R2 development, driving greater efficiency in operating expenses, launching new R1 variants, investing. So basically, like the point here that we're trying to do is we want to see if there's any information in this deck or the earnings call that is applicable to our understanding of Tesla. Okay, so any comments around raw materials, any comments around upcoming R2 production ramp. I'll know when I see it, but so we're just kind of looking for comments that's applicable, because we're not like I'm not investing in Rivian. Jacob, I don't think is investing in it, and we're not really interested in investing in Rivian either. But it's important to, I think, kind of keep an eye on other automakers, what they're saying about general trends, about the difficulties they're facing, and that just increases our understanding of the industry and Tesla overall. So let's keep going. We continue to see cost progress from our second generation R1 vehicles, which we expect to be represented in the fourth quarter, when we anticipate achieving modest positive gross profit. Okay, Rivian produced 13,000 vehicles, delivered 10,000 vehicles in the third quarter of Q 2024. As previously discussed, Rivian is experiencing production disruption due to a shortage of shares or component with our Enduro motor system. On the R1 RCV platforms, I think that's their van, our team has a strong sense of urgency in finding a solution, blah, blah, blah. Over the long term, we believe Rivian's value will be determined by scale can reach its mid-size platform, including the R2, R3, R3X. Mid-size platform expected to address global market segments and is designed to build upon our industry-leading technology platform. It's kind of reading through the fluff. The recent transition to our second generation R1 vehicles has implemented multiple new technologies, which will serve as the foundation of mid-size platforms such as zonal network architecture. So this zonal network architecture is part of the reason why I guess VW is interested in them. Rivian Autonomous Platform is a name they introduced about a year ago, I think. And positioning R2 for a simplified launch. Okay. I should probably increase the, here we go. Any comments, questions from live chats? Steve says, okay. Yeah, we have a bunch of people here actually. Oh, look at that. We have like 150 people watching. Please like and share both the X video or the YouTube channel. Subscribe to YouTube channel. We're trying to get to 10,000 subscribers by year end. That's the goal, to get to our gross profits in Q4. We believe the formation of the expected joint venture with VW will be a landmark development for the industry. The joint venture will benefit from Rivian's differentiated and well-proven zonal network architecture and full-stack software technologies, as well as enhanced software and electrical architecture innovation. The upcoming partnership with Volkswagen Group validates Rivian's technology leadership and creates new growth opportunities for Rivian to be a technology partner to our manufacturers. Other manufacturers. Okay, look at that. So I think this is kind of interesting, right? Rivian's technology leadership and creates growth opportunities for Rivian to be a technology partner to other manufacturers. So they're maybe hoping beyond VW, maybe become a supplier of some sort of, or to beyond VW. I don't know how that would work with VW probably having some sort of first dib under their partnership agreement, but this is something we can kind of keep an eye on. And maybe they even asked about it on the call. We'll see what the analysts asked on the call. Joint ventures expect to provide a meaningful financial opportunity for Rivian with a total deal size of approximately $5 billion. In addition to annual operating expense savings, Rivian expects to capitalize the planned investments in VW. In addition to the current cash equivalents short term, expect to provide capital to fund Rivian's operations through the ramp of R2 normal, as well as mid-sized platform in Georgia, enabling positive free cash flow meaning to scale. Okay, we'll see. Cool pictures. We believe the introduction of a second gen R1 along with the formation of the joint venture will enhance execution against our core value drivers. Okay. Focus on demand generation, enhancing the customer experience. Let me just skim through this. Increase our time. Okay, we talked about that. Optimize operational efficiency. Continue to focus on maximizing spend efficiency across all aspects of the organization. Compared to second quarter, third quarter, GAAP operating expenses were down $147 million. Well, that's interesting, right? So they were able to cut some expenses at the GAAP level, and it says operating expenses, GAAP, and like part of the criticism why if Rivian, even if Rivian achieves gross profits, part of the criticism was what really matters is what you're doing on the operating expense front. So they're kind of saying right here, quarter-over-quarter, operating expenses were down 147 million, marking our lowest quarter in the last 3 years. Okay. So maybe analysts may have asked about why it went down. So let's see what they said in the second sentence. Excluding stock-based comp and depreciation amortization, okay, our adjusted operating expenses for the quarter were down 77 million as compared to the prior quarter. Okay. So this is cash expenses, I guess. 1, a reconciliation non-GAAP to GAAP is provided later. Okay, we'll take a look at that. Technology leadership. We believe technology is a competitive differentiator for Rivian. Our mid-size platform is designed to build upon our industry-leading technology platform. We expect the mid-size platform to benefit from the key vertically integrated technologies developed for R1, including our in-house software stack, propulsion technology, network architecture, and vehicle electronics. Okay. Hey, Jacob, I can't really monitor the comments while I'm reading this. If you see anything that's noteworthy, you're welcome to just kind of interrupt me, okay?
Oh, sure.
Thank you. Drive towards profitability. We're seeing meaningful progress on our second-gen R1 material costs due to the new technologies incorporated into the vehicle manufacturing process. The introduction of second-gen R1 platform combined with commercial cost improvements and commodity tailwinds are expected to enable a 20% material cost reduction. Okay, interesting. Introduction of second-gen platform combined with commercial cost improvements. I'm guessing that's like battery cost declines. And commodity tailwinds. Okay, so this is where the battery cost declines are. Commercial cost improvements. Okay. Expect to enable a 20% material cost reduction when compared to R1 dual motor and large pack produced in the first quarter in 2024 versus same vehicle produced in the fourth quarter in 2024. But the RJ went on CNBC and said, I believe, if I remember correctly, he said they would achieve this milestone. So, but this one says expected to enable 20%. So that's, I should take some notes. Hold on one sec. Give me 1 second. Okay. Okay. So this is Q1 24 to Q4 24, 20% material cost reduction. Okay. Any questions?
I know he said he made strides. I've seen that CNBC interview for, clips of it anyway. I know he said he made strides when it came to the cost reduction. And the main reason why the loss per vehicle was so high was because of the equipment that they were using to substitute in and out for the new R2 platform. So, maybe they're getting real close. By Q4, I think they will have achieved this portion of the material cost reduction.
Okay, you know what we can do? We can pull up the interview, and it's right here. Okay, so I'm going to share this tab so we can watch it together. Okay, ready? I love these watch. I think these watch parties have a future here. I like it. Share this tab.
To Rivian. Shares are moving between gains and losses after a miss on the top and bottom lines. The loss per vehicle was nearly $40,000 per car. That's versus about $30,000 per car in the same quarter a year ago. Joining us now in an exclusive interview is Rivian founder and CEO RJ Scaringe, along with our own Phil LeBeau. Phil.
Thank you, Morgan. RJ, it's good to be down here in Normal, Illinois.
Yeah.
Look, Morgan set it up there. You guys had a wider than expected loss in the third quarter. You guided to a wider than expected loss for the year. You're trending in the wrong direction in terms of loss per vehicle. What happened?
Yeah, I mean, this is our core focus is on driving towards profitability. We talked about our objective of getting to positive gross margin in Q4. Q3 is really a hard quarter to see through a lot of the noise. We just made a big changeover to our second generation of our R1 vehicle. And so there's a lot of costs associated with changing out roughly half of the bill of materials as measured by cost. And so as we brought on new suppliers, there's expenses associated with that. We also had a supply chain shortage as part of this ramp up, and that really hurt us in terms of our overall output for the quarter, which affected us in terms of fixed cost absorption across all the different vehicles. But we remain optimistic around overall performance, and looking at Q4, we've continued to guide towards positive gross margin.
How do you get there? How do you get to positive gross profit in Q4 after the losses we've seen?
Yeah, I mean, one of the things when you've got so many different changes, we've talked about how do you sort of decipher that and look through the noise to see what's the real signal. The thing I'd call out is if we look at Q4 of this year, so this quarter, relative to Q1 of this year, and look at the difference in our material costs for the vehicle, we're 20% lower in Q4 than we are in Q1. And that sort of helps you see through some of the noise. So we've made real progress in terms of the overall material cost structure on the vehicle. For that and look through the noise to see what's the real signal. The thing I'd call out is if we look at Q4 of this year, so this quarter, relative to Q1 of this year, and look at the difference in our material costs for the vehicle, we're 20% lower in Q4 than we are in Q1.
Okay, so he did specify Q4. I remember it as Q3, so my mistake.
Yeah, he's including this one. I imagine by the time the end of December happens, they know they're tracking toward it.
Yeah, exactly. Yeah, I think they have a couple quarter. I think Tesla had a couple quarter advanced look into these things. So, okay, cool. So Q1 to Q4. So it's a forecast. Okay, so we'll see. All right, going back to the earnings letter. Drive towards profitability. We're seeing a meaningful progress on a second-gen R1 material cost due to new technology incorporated into the vehicle manufacturing process. The introduction of second-gen R1 platform combined with the commercial cost improvements and commodity tailwinds are expected to enable 20%. In the third quarter, we have already seen reductions in our material costs in line with our target. In addition, we have made meaningful progress in sourcing components for R2. We're approximately 85% through the sourcing of R2 bill of materials and are currently in line with our cost targets. We anticipate the material cost of the R2 AWD large vehicle to be 45% lower than the second-gen R1. Okay, these are forecasts. I hope they achieve, but we'll see. Rivian and VW joint venture. Rivian and VW's technology joint venture expects to create the next gen of electric architecture and vertical integrated software EVs. Joint venture will be highly complementary, combining Rivian's industry-leading software, electrical hardware technology, and VW's significant global scale and diverse range of vehicles and price points. Combination of strong brands and breadth of offerings is expected to enable Rivian's core technology to reach a broader set of global customers. Over the past few months, we have successfully integrated Rivian's zonal controls and infotainment system to prototype VW. Okay. Over the past few months, successfully integrated Rivian's zonal control and infotainment systems into a prototype drivable demonstrator. Okay. Prototypes are easy. Production is hard. And it took them a few months. Okay. Through our software, we have been able to integrate several functions, including vehicle core controls, different drive modes, and infotainment features, as well as enable remote controls and over-the-air updates. Okay. Any questions, comments? Tesla Doctor says maybe they should build Rivians in the VW plants that they're closing. Yeah. Okay. Moving on. More pictures. Innovation, scalable technology platform, partner choice, differentiated technology. Just kind of skimming through it. Nothing specific here. Improve cost efficiency, capital roadmap, approximately $5 billion, current cash flow, and short-term investments. Expect to provide capital reimbursement to the ramp of R2 and normal. Okay. R2 progress. We believe R2 will be a fundamental driver of Rivian's growth and profit potential. It allows Rivian to address global market segments and designed to build upon our industry-leading technology platform. R2 will benefit from vertically integrated technology developed R1, including our in-house software pack, propulsion, network, and vehicle electronics. R2 development has focused on reducing the number of parts, joints, fasteners, focus effort to drive manufacturing simplicity. Okay, this is just fluff. We're approximately 85% through the sourcing R2. Okay, we saw that already. Okay. Stamping, body, paint, and the line, general assembly, battery drive unit. Okay. We continue to make rapid progress in normal R2 production. Critical set to achieve a target of launching R2 in the first half of 2026. What do you think? Do you think they're going to get to R2 production?
My hope is that they will. In reality, I just don't see them. 2025 is going to be really, really rough for them. They're going to need more cash than what Volkswagen is giving them.
Yeah. Let's put out a poll on YouTube and say, do you think Rivian will get to? Will Rivian ever produce the R2? Okay, so this is a poll on YouTube. You can vote yes or no, and I'll read out the results later. Okay. So
how much production are we talking? Like, I think they'll make some, but I don't know if they'll be able to ramp the volume production at all with the R2.
Well, I mean, they say target of launching R2 in the first half of 2026. So that's the production start. And you're saying 2025 will be difficult for them. So but those two comments don't add up, right? You're on mute. Don't be shy now.
I really want them to succeed. I really do. Like, looking at this choice here, and it's a yes or no, I have to hit no. Like, I just don't see it. I don't see it.
Did you vote no?
I did. And I don't want to do it.
Okay. Well, you all can let me know on X as well whether you think. Let's see what the X comments are looking like here. The poll is on YouTube, but you can just hop over to the link profile.
Steve thinks they will. You know, like I hope in a prayer, but the numbers say no, is what he said. He thinks they'll figure something out. Hope is not a strategy, but we'll see.
All right, hold on one second. All right, let me know in YouTube live chat or X comments in replies to the video. This is being live streamed both on X and YouTube. What you think? Whether you think Rivian will produce the R2 in the first half of 2026. So the question really is, are they going to survive until 2026, right? And let's continue down to financials. Updates on R2 propulsion. Give me 1 second. Okay, update on R2 propulsion. Today we announced an important strategic partnership with LG to supply US manufactured cells to our upcoming R2 vehicle. LGS will provide 4695 cylinder battery cells, enabling high quality advanced battery tech to our vehicles, ensuring long range and segment leading performance. Agreement also pioneers a plethora of supply chain innovations and strengthens domestic sourcing for battery materials. Within the first year of production, the batteries are expected to be manufactured on LG's Queen Creek, Arizona plant, aligning with Rivian's focus on US domestic manufacturing and IRA compliance. Okay. Our battery pack architecture is expected to continue to evolve and improve the R2 and R3. It will be based upon a simplified pack structure, which reduces weight, complexity, and cost while also having greater energy density. We expect a meaningful reduction in dollar per kilowatt hour at the pack level when compared to R1 platform. In addition, the 4695 is a larger cell form factor than R1, which allows for reduced cell count for improved manufacturability. We expect battery pack assembly processing to improve by approximately 45%. Yeah. I mean, I hope these things happen, and that would be a huge accomplishment, but not that Tesla ramping 4680 took from 2020 to the end of 2024. So 4 or 5 years. So these things are easier said than done. And LG had its problems supplying batteries to other automakers before. So Steve says, I think Rivian will produce the R2. Numbers say no, but I say somehow they'll figure it out. Okay. Steve, by the way, you're welcome to join us. If you want to join us as a speaker here, just let me know. I'll send you a link. Vic Sarkar says they'll burn $4 billion more by then and would probably need another $5 billion for the R2 launch and ramp. Okay. Okay, cool. Software. Our intentional decision to own the software and technology hardware stack in the vehicle has been focused on improved experience for our customers. Rivian customers enjoy continuous enhancement to their vehicles via frequent over-the-air updates with 35 updates made to vehicles since launching. Available applications include Apple Music, Google Cast, YouTube. This quarter, we introduced Connect Plus. Okay, so it's a new software. Okay. A streaming and connectivity service. So it's like premium. Tesla's premium stuff. Providing customers music, audio, in-vehicle hotspot, and video streaming connectivity with an easy monthly or annual subscription. Included within Connect Plus subscription, customers can now access the Gear Guard live cam feature, offering peace of mind from in or away from the vehicle. The system includes high-res cameras embedded around the vehicle, physical cables that secure your gear, and attentive animation on the center display. Man, this live stream is like a commercial for Rivian. They should pay me some sponsorship money. You're welcome, RJ. And they tell me I don't do anything for Rivian. It's ridiculous. Anyway. Within this update, customers can see what is happening in our etc. Following the launch of Connect Plus, we provided customers a 60-day free trial period. We've seen a majority of R1 customers subscribe. Well, what's the price? What price do they subscribe? Let's just find that real quick. $15 a month. Okay. Or $150 per year. There you go. Now we know. When did they? Oh, let's see. Hold on a sec. This quarter. So in Q3. So we're going to see this in the Q4. So majority of customers. How many deliveries do they have total? I'm going to guess tens of thousands of customers subscribe. Give them 100,000 at $15 a month, 1.5 million a month, a couple $1 million. Okay. Wait, hold on a second. Following launch, we probably we've seen majority of customers subscribe from the free trial period. Okay. All right. Second gen R1 vehicles have hundreds of design engine performance upgrades. As a result of the changes in material costs, but we've seen this. We talked about this. Just kind of skimming through. Recent launch R1 configuration, tri-motor. Okay. In addition, we expect to launch quad motor in 2025 in both tri and quad while operating conserve mode. Automatically reduce issues. Okay. All of them was oil cooked or cooled. Significant improvement in thermal performance during the high torque. Okay. Go to market. Remain focused on our top funnel demand generation as we expand our presence across the country and get more customers into vehicles for demo drives. We currently have 16 spaces, including 6 new spaces, 29,000 demo drives. While we anticipate a challenging consumer background in the near term, interesting, we continue to see a significant opportunity to increase our brand awareness and have more customers behind the wheel in our organization. Okay. 10,000 deliveries. So their inventory went up by 3,100. During the third Q3, we expect to produce more Tri-Models and commercial vans and mitigating factors supply concern with Amazon increasing delivery order vans in the fourth quarter in 2024. That's interesting. Last year, they said we expect a drop because they don't take delivery in holiday season or something. I guess this year, Amazon may have changed their policy or whatever. Anyway. Demand for R1 vehicles was negatively impacted in the third quarter of 2024 by the production disruption and challenging consumer background. Due to the sequential production ramp following the planned retooling upgrade, the part shortage limited availability of specific R1 variants for sale. Okay. Path to profitability. Our long-term success and ability to make an impact will ultimately be determined by our ability to operate profitability and generate cash flow. Over the past few years, we've taken significant steps to reduce our capital expenditures and overhead costs. This includes our decision to bring the first line of R2 production normal, other organizational change we made. In addition, we remain focused on generating positive gross margins through improving unit economics on our vehicle platforms. Key drivers, revenue per unit. We anticipate an increase in revenue per unit delivered mainly driven by the increase in non-vehicle revenue, such as the sale of regulatory credits. All right, let's take some notes. So credit sales, vehicle service, remarketing, software, other services. In addition, anticipate the average selling price per vehicle to increase due to the higher mix of second-gen R1 vehicles and more premium variants like the Tri-Motor, partially offset by an increased mix of commercial vans. Okay. But the commercial vans are contribution margin positive, so. Okay. And variable costs, as part of cutover, we're starting to see single incremental costs. That's the 20%, I guess. Q1 to Q4. And then supplier negotiation, that's part of it. Design chain, that's part of it. Lower raw material, that's part of it. We also expect variable cost per unit delivered benefit to increase the mix of commercial van sales. Okay. Fixed and semi-fixed costs. We've made changes to the design of our vehicles and manufacturing process, which we expect to significantly reduce our fixed cost per vehicle delivered in the Q4. We also expect our ending inventory lower cost of net realizable value and liabilities for losses on firm purchase commitments balance to continue decreasing. Okay. I mean, that's kind of anyway. 2024 outlook. Reaffirm production guidance delivery outlook. And 1.2 billion capex. Lower production outlook for 2024 has a negative impact on our profitability for 2024 due to our limited ability to leverage the fixed cost of our production facility. Because of this, we're revising our annual adjusted EBITDA guidance to between 2.825 to 2.875 billion loss, so 3 billion adjusted EBITDA loss. Okay. That's a very narrow range for 2024 guidance. Anyway. All right, financial highlights. Let me see if I had any questions here so far. Michelle, thank you for letting me know that you're the 24th co-check number. So if you take a moment, if you're enjoying this, if you want more watch parties like this, whether it's for Rivian, Tesla, other companies, technology events, please hit the like button, subscribe to the YouTube channel. That really helps us grow and push the channel to new viewers. We're trying to get to 10,000 subs by year end. So help us get there by hitting the like button and subscribing to the channel. And we're doing this both live on YouTube and X. So feel free to like and repost on X as well. Thank you very much. Revenues. Total revenues for the third quarter 2024, 874, primarily driven by delivery of 10,000 vehicles. Sale of regular vehicles to 8 million for the quarter. So that's interesting, right? That's a little low, don't you think, Jacob?
That's what I was just about to say. I was like, why is it so low?
Yeah.
Even if it's 10,000 vehicles, it seems like It would
Well,
be
they have a cumulative of deliveries. Is really what matters, and
right.
I'm assuming they delivered more than 100,000 already, and each of them get like, I forget the exact number, but it's like 4 credits. So they should have hundreds of thousands of credits, and each one is worth like a couple $1,000. So they should have hundreds of millions of dollars. Why they only sell 8 million? I mean, they can be bumpy and everything, but that's something to keep in mind. Why is it only 8 million in Q3? Maybe, you know what? Maybe they are kind of holding on to some of them for Q4 to hit that gross profit number.
To make their number. Yeah.
Yeah. So that's something to like. This can be lumpy, and we'll see. We'll see if they catch it. If you see a big jump quarter over quarter. Okay. Compared to Q3 2023, a portion of decrease was driven by timing of higher EDV deliveries in the third quarter of 2023. Following the first quarter of 2024 line shut down, the remaining portion of decrease was driven in part from our production disruption. Okay. Gross profit. We generated negative gross profit of 392 million. Compared to 470 a year ago. Gross profit losses decreased year-over-year primarily due to lower delivery volume. Yikes. Gross profit losses per unit increased primarily due to an increase in cost of revenue efficiency initiatives and smaller reduction of RC and RV of inventory losses on firm purchase commitments. Okay. Did you hear that?
Yeah, it was pretty loud.
Sorry. Let me put myself on do not disturb. Third quarter of 2024 was impacted by a charge of LC&RV write-downs on inventory and loss on purchase commitments. Our ending inventory balance includes LC&RV write-downs of 130 million, while liabilities for losses on firm purchase commitments were 10, for a total of 140 at the end of the third quarter of 2024, as compared to our ending inventory balance at LC&RV write-downs of 292. Okay. This is non-cash stuff, so I don't really focus on this stuff too much, but I know it's a big topic among the Rivian crowd. The key drivers for our path to positive growth includes increasing our revenues per delivery unit, reducing variable costs, and reducing fixed and saving costs. Okay. Operating. All right, let's see how they decrease their operating expense. 777 as compared to 963 a year ago. Third quarter of 2024 was we recognized non-cash stock-based comp expense within operating expense of 105 as compared to 219 in the third quarter of 2023. And depreciation amortization expense with operating expense of 73 million as compared to 80 in the third quarter of 2023. Okay. R&D, 350 million is compared to 590. Look at that drop. That's wild. 350 million to 529 million in the same period last year. So one thing about Tesla is that they kind of tend to keep their R&D expenses at a pretty healthy clip. R&D is obviously very primary focus for Tesla, and they try to cut down on SG&A as much as possible, selling general administrative stuff as much as possible. So, it's good to cut this, but like on the other hand, like all of these things have a positive and negative. So what does that mean for R2 development or R3 development down the line? But let's see what they say in the next sentence. The decrease was primarily due to the $74 million decrease in stock-based comp expense, primarily related to a reversal in the accrual of a previously recorded stock-based bonus expense and decreased grants. Okay. Interesting. So they accrued the expense. This was non-cash expense, obviously. Stock-based comp expense, they accrued it, and then it got reversed. It may be due to people leaving or getting laid off, fired, I don't know, or some other reason. A 57 million decrease in engineering, design, and development costs and other related project costs, primarily surrounding R1 platform design technology upgrades, and a 30 million decrease in D&A. Okay. SG&A was 427 million compared to 4. See, that's what I mean. Like, this is the exact opposite of what Tesla does. Tesla reduces SG&A and it really keeps R&D and they help the clip. And what Rivian is doing here is reducing R&D, but the SG&A is flat. But I think later on they have some sort of like a quarterly financial statement, so maybe we can look at the more multi-quarter trend here. SG&A expenses remain relatively flat compared to 3 months and a year ago, with a $40 million decrease in stock-based comp, primarily related to reversal in the accrual previously, same thing as above, 23 million increase in D&A, and 17 million increase in SG&A to support go-to-market. Okay. Thank you very much, No Clue, for the $10 super chat. Let me know if you have any message for the audience. Man, look at this. We got 400 people watching on X and YouTube combined. That's pretty cool. Adjusted R&D for the third quarter, 271 million compared to 346 million for the same period last year. Adjusted SG&A, 328 million as compared to 318 for the same period last year. Okay, this is going to take longer than I thought, but that's all right. We have enough to keep going. Okay. Net loss 1.1 billion compared to 1.4 last year. Adjusted EBITDA, adjusted net loss 1.1. Okay. Net cash used in operating expenses. FX. Okay. Liquidity 6.7 billion in cash and short-term investments, including capacity. So like sometimes one thing I see people do is they kind of look at this cash and they say, let's say, for example, Rivian is losing $1 billion in cash per quarter, or losing $1 billion per quarter. People look at this cash balance and say, oh, Rivian has 7 quarters. But that's not how it works, because every company needs a minimum amount of cash to keep operations going, whether it's paying suppliers or your employees, or just financing inventory type of stuff. So my guess of what Rivian needs, just to at the bare minimum cash balance, is about $2 to $3 billion. So in my mind, they have about $3 to $4 billion left. And if they continue to lose $1 billion a quarter, that's 4 quarters left, basically. But this obviously doesn't account for what VW has promised. So if they, finalize this joint venture, and I'm assuming it has some stipulation around achieving gross margin profit or something, and if they get to that, then VW puts in a few $1 billion, and that gives Rivian another year, I guess, if they can continue to improve their free cash flow. And but on the other hand, VW has its own problems, so that's also a bit of a problem here. Like a -1 plus a -1 doesn't do 0. So anyway, Jacob, what do you think?
No, it sounds good. And if everything goes smoothly, right? So, I think when you're going to be dealing with, is it sustainable? They'll probably get the number. I think if they guided to it, they're going to get to their gross profit margin number. The question is, what does Q1 2025 look like? And it's going to show that it's not remotely sustainable with what their supply challenges. That's if everything is perfect, and I think they're going to run out of money. And if whatever VW stipulation is when it comes to, here's a couple more $1 billion to keep your people employed, I think it's going to be razor thin. And then again, nobody in Europe wants to see VW give that money to Rivian when they're closing plants. This is going to be a really tricky situation. And if they're able to get the money and they're able to generate some catalysts, maybe, but it's got to be absolutely perfect. And it's not easy. Tesla makes it look easy, and it's not.
Yeah, Tesla makes it look easy. I agree. Thank you. Okay. Third quarter of 2024, ending cash equivalents, and short-term investments balance of 6.7 billion includes 1 billion of unsecured convertible note issued to Volkswagen. Unsecured convertible note. Okay. In association with the announcement of our expected joint venture VW. The convertible note will automatically convert into shares of Class A common stock on December 1, 2024, as all conversion conditions have been satisfied as of September 30. Okay. So that's dilution incoming. It's about a 10% dilution for given their market cap right now. But this is known and it's probably priced already into the stock. We define free cash flow as net cash used in operating activities less capex. This is the same definition as Tesla, but it's a shortcut, a Wall Street shortcut, which is fine. The increase in year-over-year capital expenditures discussed above resulted in negative free cash flow. Not one. Okay. We define free cash flow as so the negative increase in year-over-year capital capex discussed above resulted in a negative free cash flow of 1.153 billion for the third quarter of 2024 as compared to 1.067 billion for the same period last year. And then there is the audio webcast that we're going to go into in a second. Okay. Give me 1 second and then we're going to do a review of these. I got to stop this dryer from singing. All right. Financial statements. There you go. There's the quarterly stuff. So delivery is going down, not a good sign. Obviously, Q3 is generally a seasonally strong time of the year. You know, seasonally weak for capital goods is December, January, February time, and everything else is kind of normal. And spring is above season. So this is not a good sign right here. Negative gross margin of 45%. Okay. R&D lowest, and it's been declining for 5 quarters straight. SG&A flat. So like this is the exact opposite of what we want to be seeing here. Total OPEX. Okay. Loss from operations. There's a bit of improvement here, as you can see. Okay. Interesting. So let's say, for example, they have hundreds of thousands of credits in the bank. I mean, we can look at their balance for ZEV credits, but like if they, they can actually get up to like a couple $100 million if they find buyers for it, obviously. And Tesla's already in the market selling too. So I don't know. That may be why they're kind of not getting more than $8 million in Q3 because maybe Tesla's in the market selling too. I don't know. Tesla is selling hundreds of millions of dollars of them per year, per quarter. Net loss. Okay, we got that. Any questions, comments about the financial statements? Please leave in the live chat. Cash down from 7.9 to 6.7, even with VW's 1 billion. Free cash flow 1.1 billion. So I'm guessing they improved their AP then. We'll keep an eye on that balance sheet. Total DNA. flat. Stock-based comp, cost of revenues, 23, 21, 23, 17, 6. R&D, lower. SG&A, okay. Inventory else NRV, okay. Condensed balance sheet, cash and cash equivalents, short-term investments. So cash equivalents are like cash, obviously. Cash equivalents would be something like just very short term, maybe a 1, 2, 3 month kind of treasury bills, or like funds that hold those very short term bills. Short term investments would be anything less than 1 year. Treasury bills, usually what companies hold. I'm guessing this is more like money market stuff, cash and cash equivalents, or like notes, etc. And inventory, same. This is December to September comparison. PP&E, same. Operating leases, not much of a change here. AP, see, look at that. They pay their suppliers quite a bit. And the reason why I kind of like guessed that is because their cash went from 7.9 to 6.7, but they have the 1 billion from, so let's say, for example, 7.9, 1 billion from VW. This is June, right? Exactly. 7.9, 1 billion from VW, 8.9 minus 1.1 should be 7. Yeah, 7.8, right? Yeah, but it's 6.7. So there's a 1 billion, and something doesn't add up just based on this information. So I was like, that's got to be accounts payable dropping, and that's the most likely scenario. And you can see here there is a nearly $400 million drop in AP, and then also a $300 million drop in accrued liability. So that's together, that's about 650 drop. So that explains that. And then let's look at the AR. There's a $50 million increase, and then 40 million in the other current assets. Okay, cool. So now it adds up. Non-current lease, non-current liabilities. Interesting. 200 million increase there. Long-term debt, that's the VW note. Okay. But this is December to September, so that doesn't make sense. Hold on one sec. So that's 9 months. We should be comparing that to June 30th. So TBD, I guess. Okay. Condensed consolidated statement of operations, 3 months, 9 months. Gross profits, okay. We went over all this stuff. Net loss 4 billion, 4 billion. Weighted average of common shares outstanding, basic and diluted. Okay. Why would that be this? Okay. Why would that be the same? Anyway. Net cash used. So this is the cash flow statement. Net cash used in operating expenses. Activities. So 4 billion net loss. This is for 9 months, year-to-date period versus year-to-date last year. Same, starting with so this line comes from net income statement. So this is bottom line from net income, starts the cash flow statement. And then you make a bunch of non-cash adjustments. So depreciation amortization is a non-cash expense that's in this net loss number, but it shouldn't be in the cash flow number. So they add it back. So this goes to like negative 4 billion to negative 3.2. And then they keep adding, stock-based comp is a non-cash expense. So they add that back, and then a bunch of other non-cash stuff. And these are changes in operating expense, assets, and liabilities. These come from balance sheet line item changes. So in the 9 months. So and then you deducted. So they had an investment. So the inventory increased from beginning of 2023 to September 30, 2023 by 1.5 billion. So they increase their inventory. That's a working capital investment, and that reduces your cash flow basically. So that wouldn't be in the net income number. These are just some accounting topics that people, if they're interested. But this is I highly recommend taking some sort of a intermediate accounting class. You can learn about these things on YouTube for free, or you can Harvard or other schools have free online resources that you can read about if you want to do financial statement analysis. But in my CPA exam, we have to build a cash flow statement, for example. So you have to kind of be able to do these things from scratch. 2.9 billion, 3.8 billion net cash operating activities. Cash flow from investing activities. Purchase of short-term investments, maturity of short-term investments. Okay. I mean, not much to see here. And then, okay, cool. DNA, not much there. Stock-based comp, not much there. We went over all that stuff. Reconciliation. I don't really have any questions about the reconciliation part of it, so we can skip that part and get straight to the earnings call in a bit. Okay. Some restructuring, fair value gain and loss convertible note. Okay. That's per share. Okay. This is reconciliation stuff. Not any questions, so skip that. Not much here. Forward-looking statements. Okay. You ready for the call? Anybody need a break?
No, I'd love to hear it. When I started investing, I really got into back in 2020. I bought my first Tesla, and I got really into understanding what the financial sheet. Because if I wanted to start investing my money, I wanted to kind of understand what was going on. So YouTube U, I didn't get my degree in finance or anything like that, but YouTube U and sampling a bunch of other different channels allowed me to kind of get a decent idea of what they were talking about. So I recommend it. If you're going to be an investor, you might as well understand what is going on. But looking at Rivian's sheet and watching you go through that, my brain started to hurt. Why can't there be just a standard uniform way that all of these companies do it? I hated it when Tesla would change CFOs. Like, why is this different all of a sudden?
Yeah, I mean, there's a standard. It's called GAAP, General Accepted Accounting Principles, right?
No, but the only thing I really did do in the military was, formatting, and it just seems like this thing isn't formatted like it should be. It's just painful on the eyes.
Yeah, that's all right. I mean, once you kind of get some experience in reading these things, you just know what to look for anyway. And like 90% of it is kind of just making sure nothing material has changed, and 10% of the information is what really matters most of the time. So anyway, let's move on. All right. Earnings call. Any questions, comments about the financial statements, please leave in the YouTube live chat or in a reply on X. And I'm looking through the replies at the same time. During the call, I'm going to pause. And if I hear anything, I mean, I wouldn't expect it to be too often. But if I hear anything that's applicable to Tesla, then we'll pause it, we'll discuss it. If not, then we'll continue through it. And I'll be in live chat as well, just discussing what we're hearing. So hop over to YouTube, join us on YouTube live chat, hit like and subscribe and share this video with others so that we can continue to grow this YouTube channel and bring you more information just like this. All right, let's get started.
Hi. Welcome to Rivian's third quarter 2024 earnings conference call. At this time, all participants are on a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 11 on your telephone. You will then hear an automatic message advising your hand is raised. Please note that today's conference is being recorded. I will now hand the conference over to your speaker host, Tim Bay, Vice President of Investor Relations. Please go ahead.
Good afternoon, and thank you for joining us for Rivian's third quarter 2024 earnings call. Today, I'm joined by RJ Scaringe, our CEO and founder, Claire McDonough, our CFO, and Javier, our Chief Operations Officer. Before we begin, matters discussed on this call, including comments and responses to questions, reflect management's views as of today. We will also be making statements related to our business, operations, and financial performance that may be considered forward-looking statements under federal securities laws. Such statements involve risks and uncertainties that could cause actual results to differ materially. These results and uncertainties are described in our SEC filings and today's shareholder letter. During this call, we will discuss both GAAP and non-GAAP financial measures. A reconciliation of GAAP to non-GAAP financial measures is provided in our shareholder letter. Just before the call, we published our shareholder letter, which includes an overview of our progress over the recent months. I encourage you to read it for additional details on some of the items we'll cover on today's call. With that, I'll turn the call over to RJ, who will begin with a few opening remarks.
Thank you, Tim, and thank you all for joining us today. I'm going to start by talking about the R1 and specifically the Gen 2 ramp-up. First, the material costs progress we've made, as well as the efficiency improvements within the plant, are really important and critical for our long-term profitability as a business. Those changes and a lot of the changes that went into Gen 2 were focused on cost, but we also introduced hundreds of other design and engineering changes that enhance the performance of the customer experience in the vehicle. And one of those is the introduction of a new variant, what we call our tri-motor. This puts a single motor in the front and two motors in the back, and it delivers really exceptional performance. Performance that's better than our first generation quad, but with a much lower cost in terms of what it takes to manufacture it, and also with a substantial improvement to efficiency. And we're seeing a lot of excitement around the Tri, and we're excited to also be bringing the quad to market, the updated quad, in 2025. Now, with that, we had a bunch of suppliers who brought on with the Gen 2. Around 50% of the bill of materials by cost is with new suppliers or with new contracts. And with that, there's been some challenges, and those have really impacted us in the quarter. And this has been a tough quarter for us because of some of those supply chain or supplier ramp challenges. And one of those suppliers in particular has limited our production quite substantially, and we're working very, very hard to address that. This is one of our highest priorities in terms of the business, and we're seeing this as really a short-term issue, but it certainly introduced challenges as we saw in Q3. Now, a lot of the learnings that went into the Gen 2 ramp up, the design of the components, the design of the systems, are underpinning what's going into R2. And the R2 program is advancing. It's from a timing point of view, it's on track, and the product itself is really exciting. It's delivering a level of performance and capability in a package that really looks and feels like Rivian, but it's doing it at a substantial reduction in terms of its overall cost. And a key part of this isn't just the design of the components; it's also all the supplier relationships that we've grown and built through R1. And today, as it stands, we've sourced about 85% of the bill of materials on the R2 program, and that 85% that's been sourced is within our aggressive cost targets we've set for the program. And we've talked about these at our investor day, but this is overall going to be what allows us to reduce the cost of R2 relative to R1 on a sort of a like-for-like basis in terms of content by about 45%. Beyond just the cost focus that's gone into R2, this is also a program that's really been architected around creating something that's special and unique in the marketplace. And our key objective is to make sure we can capture the same level of market share and excitement that we've done with R1, where R1's one of the strongest market share players for vehicles, flagship vehicles over $70,000. And our hope, and of course what we're targeting, is to capture that same level of excitement, but at a price point starting at $45,000 with R2. The key to delivering all this is of course, the launch of our plant and the production line here in Normal. And the expansions we're making to the facility are well underway. The grading work at the site level is essentially done. This positions us to start deliveries of R2 in the first half of 2026. And so that the progress is being driven into the plant, the learnings from R1, and of course the supply chain relationships we've established and the contracts we're putting in place are really critical for both delivering on the timing, but also the aggressive cost targets we've set for this program. Now, we also announced today that the sourcing of battery cells for the program, and we're using a cylindrical cell, a 4695 cell, so 46 millimeters in diameter, 95 millimeters tall. And that relationship with LG is something we've been working on for quite some time. And those cells go into a really uniquely designed pack where the modules and the pack in conjunction with, of course, holding the cells act as a core structural element of the vehicles. This is a structural battery pack where not just the structure of the pack is part of the body, but the top of the battery pack actually forms the floor of the vehicle. And so these are the types of decisions we're making across the R2 program to drive cost efficiency through part elimination or part consolidation, which is key for us delivering at the price point we've talked about with R2, but doing that with a healthy positive gross margin. Now, beyond body structure, battery sourcing, the vehicle architecture, some of the things we've talked about, one of the other really important elements of R2 is leveraging the electrical architecture, our topology of ECUs, and the software stack we've developed, and put that into the Gen 2 of R1, is that platform underpins R2. It's also core for our joint venture with Volkswagen. And the joint venture with Volkswagen continues to progress well. We remain really excited about this. Our teams are passionate about the impact we can drive through leveraging and seeing our technology make its way into so many different vehicles. We have a drivable demonstrator where we've put our hardware and our software into a Volkswagen Group product. And the investments from Volkswagen as part of this joint venture, which we've talked about in the past, these are really important for us. These allow us to not only fund the continued growth of Rivian and through the launch of R2 and Normal, but also allow us to launch our production plant in Georgia, where that will not only produce R2, but other vehicles on this mid-size platform. And ultimately, the capital we have, plus the capital provided by the joint venture, will take us through positive free cash flow. Now, I said it before, and I do want to end by just restating the importance of creating highly compelling product in driving the transition to electrification. You know, we've seen that with R1. The R1S is the most popular SUV over $70,000 in California, and that's not just the most popular electric SUV; it's the most popular SUV sold in California. We're hoping to see that level of excitement continue and carry through with R2, as I said. And ultimately, that's what's going to help pull customers out of combustion vehicles, internal combustion vehicles, and into EVs, as the features and the capabilities of the vehicle being so exciting that it helps draw customers in. And so that's our focus. That's what has us incredibly optimistic around the future. And we'd like to thank all those that continue to support this vision. This is our employees, our customers, partners, suppliers, of course, our communities, and lastly, our shareholders. So with that, I'll pass the call to Claire.
Thanks, RJ. During the third quarter of 2024, we made progress driving greater cost efficiency and validating the differentiated nature of our technology stack. During the third quarter, we produced 13,157 vehicles and delivered 10,018 vehicles, which represented the primary driver of the $874 million of revenue we generated. As mentioned on our second quarter earnings call, we expected Q3 deliveries to decrease on a sequential basis due to the reduced R1 inventory. We started the third quarter with low finished goods inventory of R1 due to the successful sell down of our first generation R1 vehicles in the second quarter. Demand for R1 vehicles was negatively impacted in the third quarter of 2024 by the production disruption and challenging consumer backdrop. The sequential production ramp following the plant retooling upgrade and the part shortage limited availability of specific R1 variants for sale in the third quarter. Total gross profit was negative $392 million. Our gross loss per vehicle delivered was approximately $39,100, which includes $18,600 of depreciation and amortization expense and $600 of stock-based compensation expense. In addition, we incurred approximately $3,700 per vehicle delivered in the quarter related to our cost of revenue efficiency initiatives, which we do not anticipate being part of our long-term normalized cost structure. The introduction of the second generation R1 platform, combined with the commercial cost improvements and commodity tailwinds, are expected to enable a 20% material cost reduction when comparing an R1 dual motor with large pack produced in Q1 2024 versus Q4 2024. Importantly, in the third quarter, we saw a meaningful reduction in our second generation R1 material costs as compared to our first generation. This is in line with our target, and we expect to see this continue into the fourth quarter. We remain focused on driving greater cost efficiency throughout the company and continue to see this result in lower operating expenses. Our GAAP operating expenses in the third quarter were $777 million, which is the lowest level we've had in 3 years and a reflection of the cost savings initiatives we've put in place. We are reaffirming our annual production guidance of 47,000 to 49,000 vehicles. We expect to increase our tri-motor and commercial van production and deliveries in the fourth quarter, as those variants only require one enduro motor. I want to emphasize we believe this is a short-term obstacle. We are reaffirming our annual delivery outlook of low single-digit growth as compared to 2023, which reflects a range of 50,500 to 52,000 vehicles. We expect to have a modest GAAP gross profit in the fourth quarter of 2024. This is supported by 3 key drivers. First, revenue per unit is expected to increase, driven by an increase in non-vehicle revenues such as regulatory credits, service, remarketing, software, and other services. We now expect to have a total of approximately $300 million of regulatory credit sales in 2024. We also expect to see an increase in the R1 average selling price as we improve our sales mix with more meaningful tri-motor sales in Q4. Secondly, as part of the transition to our second generation R1 vehicles, we are seeing an improvement in material costs due to the design changes, supplier commercial negotiations, and lower raw material costs. We also expect the increased mix of EDV sales in the fourth quarter will also help drive down our variable cost per unit delivered. Lastly, based on changes to the design of our vehicles, improvements in the manufacturing process and depreciation of our initial vehicle tooling, we expect to reduce our fixed cost per vehicle delivered in the fourth quarter. We also expect LCNRV and firm purchase commitment balances to continue to decline in the fourth quarter. The new technologies introduced into R1 were strategically designed to benefit R2 in the long term. In addition, building the R2 in normal first allows us to best leverage our operations leadership team and existing manufacturing and logistics operations and overhead costs. Because of these benefits, in addition to the significant progress we've made sourcing R2, we anticipate R2 as having a much faster path to profitability as compared to R1. While we continue to make progress on R1 cost structure in the near term, our team is focused on addressing the component shortage impacting our ability to produce enduro motors. Due to the lack of fixed cost absorption associated with the lower 2024 volumes, we are revising guidance for our 2024 annual adjusted EBITDA to between $2.825 billion loss to a $2.875 billion loss. CapEx guidance for 2024 is unchanged at $1.2 billion. Looking ahead, we are excited about the significant opportunity of our joint venture with Volkswagen Group. As RJ mentioned, the proceeds we anticipate receiving following the formation of the joint venture and certain milestones, together with our $6.7 billion of cash equivalents, and short-term investments, are expected to fund Rivian's capital roadmap for growth. with the ramp of R2 in Normal and build out of R2 and additional variants in Georgia, taking Rivian to free cash flow positive. We are excited to share the cost savings potential, milestones, and other benefits upon closing, which we expect to happen this quarter. I wanted to again thank our team, partners, customers, suppliers, and shareholders for their tremendous support. With that, let me turn the call back over to the operator to open the line for Q&A.
Thank you. Ladies and gentlemen, to ask a question, you will need to press star 11 on your telephone and wait for your name to be announced. To withdraw your question, simply press star 11 again. In the consideration of time, please limit yourself to one question and one follow-up. Please stand by while we compile the Q&A roster. Now, first question coming from the line of Emmanuel Rosner with Wolfe Research. Your line is now open.
Thank you so much. My first question is around the improvement in the gross profit and implications for the unit economics on R1. Obviously, you expect a fairly meaningful amount of rec credits in the fourth quarter, and then it's a modest gross profit. So I would assume, without it, it's still, somewhat unprofitable. But can you maybe comment on where you are in the path of improvement in unit economics? How should we think about it in terms of how much does fourth quarter mean for how do we think about it for 2025, and which other levers you have to keep improving it, please?
Sure. Thanks, Emmanuel. As you noted, one of the primary drivers of the improvement that we anticipate seeing in our gross profit as we drive to Q4 positive gross profitability is the growth in revenue per unit. And so that's been driven by both the $300 million that I talked about in terms of regulatory credit sales that we anticipate achieving throughout the course of this year, as well as some of the improvements that.
Okay, I'm pausing this for a second. So any questions, comments on management commentary first before we continue with the analyst questions? Any questions, comments on management commentary? Please leave in live chat or reply in the X stream as well. Jacob, did you see anything new, unexpected?
Not particularly. Hopeful. That sounds good.
Okay. She did say that they sold 300 million regulatory sales year to date, right? So that would be about 100 million per quarter. So the Q4 number, the Q3 number of 8 million is actually very low compared to that. So that's in line with, I think, maybe if they're holding back some regulatory credit sales in Q2, if they held back to sell it in Q4, that could benefit that gross profit number. So I would expect somewhere between $100 to $200 million of sales in Q4. So that's something to keep an eye on. And they did say van sales, she expects van sales to lower COGS per unit COGS. So their van sales to Amazon is already contribution margin positive. We've known that for a while. So if they get some sort of like a big rush of deliveries to Amazon Q4, that would also be very positive for the gross margin and the bottom line as well. So,
but highly unlikely, right? I mean, unless Amazon is just going to make an exception for them, right?
Yeah, I mean, if they're saying that, if we go back to this, we expect to produce more tri-modals and commercial vans as a mitigating factor to the supply chain, with Amazon increasing its delivery order of vans in the fourth quarter. So we already know they have a certain number of vans they're going to sell to Amazon, deliver to Amazon. So we know that, they know that. So that's part of guidance that I would assign a high probability of that happening to that part of guidance. Okay. Now, we mentioned this before. So like GeoGuy85, for example, says, I just pulled up to the screen, Amazon held off Q4 last year. I know. And Rivian Management said Amazon doesn't take deliveries in the busy holiday season in Q4. So all of a sudden, this year, what, Christmas got canceled? What's going on here?
Maybe the supply chain issue caused them to to hold off, and they're just going to take these in the Q4 season,
Yeah,
going against their guidance normally.
whatever. Anyway, listen, I hope the company succeeds and survives and all that good stuff, but we're here to just kind of point out these, ups and downs, so positives and negatives. And we're trying to learn as much as possible from other company earnings releases, information that we can apply to Tesla. So this is a watch party that's going to continue. We're in the earnings season right now. There are other companies that I want to read about and learn about. For example, we can look into dealerships, their publicly traded stocks, and see what we can get about inventory levels across the industry. We can look into AI companies to see what we can learn about what they do different than Tesla in their, whether it's autonomy development or robotics development, and kind of think through these decision differences. So thousand decisions go into these products. So each one matters, and we can dig into a deeper level of understanding with Tesla through these watch parties, I think. Okay, so let's continue with the analyst question and answer session. All right.
Comment on where you are in the path of improvement in unit economics. How should we think about it in terms of how much does fourth quarter mean for how do we think about it for 2025, and which other levers you have to keep improving it, please?
Sure. Thanks, Emmanuel. As you noted, one of the primary drivers of the improvement that we anticipate seeing in our gross profit as we drive to Q4 positive gross profitability is the growth in revenue per unit. And so that's been driven by both the $300 million that I talked about in terms of regulatory credit sales that we anticipate achieving throughout the course of this year, as well as some of the improvements that we'll see in our average selling prices. As we translate that into 2025, as well as on a revenue per delivered unit, in 2025, we'll also be launching our quad motor offering as well. So that will also be a tailwind as we think about overall ASP increase catalyst for the business as a whole. So that'll be another driver as we think about the go forward progression. The next piece is we look at the variable cost per unit improvement. While we'll continue to see progress in our reduction in material costs from Q3 into Q4, we'll continue to see tailwinds as well as we work our way into 2025. We still have meaningful commodity cost improvements that are still yet to be achieved. And then we've seen and continue to see the R2 sourcing process is another tailwind for us as we look ahead to continued improvements, especially from a commercial cost down standpoint, from a variable cost per unit. The last piece is as we look at overall fixed cost per unit dynamics. Clearly, the reduction in our production guidance for this year did have an impact on the progress in this category in particular. But we've seen additional operational efficiencies that we're driving within our production plant through the pivot to our Generation 2 R1 vehicles as a whole. And then we'll continue to see both in the fourth quarter and in 2025 a step down in our depreciation expenses on aggregate as well, given we're now 3 years into production and we've largely depreciated the majority of our initial tooling from our starter production standpoint as well.
Okay, what did you think of that answer?
I really have no thoughts.
So she basically walked through pretty much what they've said before. One takeaway from that is they're banking on average selling price increase due to these new products that are coming in, the tri-motor, quad motor, etc. And obviously that assumes that there's going to be demand for those vehicles, right, in the coming quarters. But they don't know, obviously. People might choose the Cybertruck, they might choose the Cybertruck Beast or the dual motor, etc. And the future is uncertain. But they're kind of incorporating an ASP increase. Okay, If that happens, that's great. And then the other thing that she said is that I think is important here is she says, while we'll continue to see progress in our reduction in material costs from Q3 into Q4, we're going to see tailwinds as well. We work our way into 2025. And then she says, we still have meaningful commodity cost improvements that are still yet to be achieved. Okay. So that's right there, because commodity costs are pretty much uniform across the industry. That is a sentence that we can maybe apply to Tesla as well. So Tesla had a massive improvement in COGS per unit in Q3. And part of it is due to raw material price decreases, like lithium prices have declined quite a lot, and other commodity prices as well. She doesn't specify which commodity price, but I'm guessing with EVs, a lot of it is just battery prices. So we might see a continuation of COGS per unit decrease in Tesla as well, based on that one sentence. But might give it 50% probability. And then that's just one indication we can pull away from this Rivian earnings call, applied to Tesla insight. Okay, so this is something we'll probably discuss in Tesla Live on Monday. Okay, let's continue.
Okay, that's a lot of great color. Just maybe my follow-up would be then, based on all these factors, would you expect 2025 gross profit to also be positive? And can you give us some sort of indication of how to think about reg credits for 2025?
Sure. Our goal remains that we are trying to target a positive gross profit for 2025. I will say that we're operating today in a fluid environment, and we'll provide additional details on that outlook for 2025 on our Q4 earnings call, when we'll provide our more formalized guidance for the full year as a whole. As it pertains to regulatory credits, we do have visibility into future opportunities for the sale of our reg credits into next year, and would expect them to be in line with what we've seen here for 2024 as a whole.
Okay, so that's interesting too, isn't it? So right now, so she says, I'm looking at the transcript in the meantime, just makes it easier to kind of follow. I don't think I can show it here while also having the audio, so apologies, but you can also just Google Rivian Q3 2024 transcript, and you can see that as you kind of listen to it. So she says, as it pertains to regulatory credits, we do have visibility into future opportunities for the sale of our regulatory credits in the next year, and would expect them to be in line with what we've seen here for 2024 as a whole. So that's about $100 million per quarter rate for them, and for Rivian. And so Tesla is obviously selling more because they just, they have more opportunities in different geographies, and they have more accumulated credits and everything. So, so that's something that potentially we can take away for Tesla as well, is that regulatory credit sales for 2024 versus 2025 could be about the same level. Okay, let me just kind of pull up real quick. Yeah, I'll just do that some other time. All right, let's continue. Any thoughts on that, Jacob?
No, they're going to give more clarity, especially in Q4, but I think they can only expect it to continue the same way it has been in 2024.
Okay, continue with the next question.
Thank you.
Thank you. Now, next question coming from the line of Adam Jonas with Morgan Stanley. Your line is now open.
Thanks, everybody. So you highlighted a challenging consumer environment. Just wanted to drill in on that. Can you remind us what percentage of your volume in the quarter is pre-ordered versus sold out of dealer inventory, and how is that changing? And I'd also be curious, given events of this week, if you could remind us what portion of your sales are to customers who realize a full $7,500 tax credit, and also what percentage of your sales are leased? And can you confirm how Rivian is, that Rivian is not taking any direct residual value exposure related to those leases? Thanks.
Sure, Adam. As we think, maybe I'll take the second part of your question first on leasing. Overall lease penetration was 42% within the quarter. Chase is our lease partner, and Rivian, together with Chase, shares in the residual values of the vehicles that we have as part of that leasing program. And it's something we utilize, third parties to mark the residual values that we anticipate achieving, and it's something that our team, studies carefully on a monthly and quarterly basis as we adjust our reserve levels accordingly to what we're seeing in the broader market backdrop as a whole. As we think about the overall mix of volume from pre-orders, in Q3, we had the end of our early pre-order pricing volumes as a whole. So we did see an uptick overall in terms of consumers that were those early customers that were utilizing that early lower pricing to their benefit as they purchased a Gen 1 or the remainder of Gen 1 vehicles as a whole in Q3. And then in terms of the percentage of sales that receives the $7,500 credit, it's largely our population of lease consumers that are able to take advantage of that credit, given the price point of our vehicles and the overall income levels. Most of our customers don't qualify on a financed or cash purchase.
Thanks, Claire.
What'd you think?
Well, I really don't know what to think. I don't think they answered this question first and foremost. They're just regurgitating what's already in the report for the most part.
Well, so this lease penetration number is interesting. She says 42% of I guess deliveries are leases. And the Rivian has very aggressive lease rates. So that's not very surprising. Okay. But what that means is, so that number, just to put in perspective, for Tesla is like 2-3%. Okay. Tesla doesn't really want to build this massive lease business. And because it becomes a liability for the future. So the balance sheet becomes dependent. So when you lease out a vehicle, that vehicle sits on Rivian's balance sheet. And this is true for all automakers. Okay, Ford, GM, BMW, etc. That lease penetration for Rivian is 42%. For Tesla, it's 2-3-4%. And for BMW, it's like 60, 70, 80% sometimes. It depends on geography. Okay, so the higher that percentage is, the more your balance sheet has a residual value risk, meaning if the resale value of your vehicles don't hold up to estimates for whatever reason, then you have to recognize that as a expense down the line on the balance sheet and on your income statement. So you have to write down the asset value on the balance sheet and recognize the expense on the income statement. It's a non-cash expense, but still it impacts your debt to asset ratios, leverage ratios. It can impact your credit rating, and so forth. So what Rivian and legacy automakers are doing is that using leases to increase their deliveries in the shorter term, but they're introducing a residual value risk to their balance sheet in the longer term. Tesla does not do that. This is a very important difference between Tesla and other automakers. Elon has answered this question back in like 2014, I think, when an analyst asked and said on an earnings call like this, and said, now that you kind of established Model S as a successful vehicle, why don't you lower these lease payments, basically kind of sweeten these lease offers to increase deliveries? And Elon said, just straight up, we're not going to do that. And that's how these automakers get into trouble And this is obviously right, a few years after GM filed for bankruptcy and everything. And so he set a strategic priority or strategy for Tesla that Tesla is not going to do a huge leasing business. And he's held onto that promise over the last 10 years. And that leasing percentage for Tesla has been a couple of percent. Tesla can easily do what these automakers are doing. There's no reason Tesla cannot, is not able to do what these automakers are doing. Tesla can easily get up to 3 million units per year deliveries, fill up its production capacity through leasing. But Tesla doesn't want to do that. So for that reason.
Yeah, I guess it's counterproductive, especially if you're driving your ASPs down. Like if that's your mission to get the lowest vehicle out there. So when you're talking about leasing them and they're still on your balance sheet, now they're worth less than when you lease them. I guess that's probably a major factor of not wanting to do that.
No, that's not true, because
Okay.
lowering the lease payments would actually increase affordability for Teslas, for people, right?
Right.
And they have done that with some Model 3s and Model Ys and everything, but for whatever reason, people choose to buy Teslas. But Tesla can do more. Like Tesla can lower these lease payments even more if they want to kind of push that leasing business, but they don't. But I don't think it's because of affordability. I think it's more of a kind of balance sheet conservatism for Tesla. We've seen many examples of Tesla being very conservative with their balance sheet in the past on many fronts. And one of them, for example, is that Tesla doesn't carry a recourse debt on its balance sheet. So they have $30+ billion of cash, very little recourse debt, and it's a very clean balance sheet. It's one of the cleanest. It's definitely the cleanest in the industry. It's one of the cleanest in the world of any sector. So Tesla, Elon, for whatever reason, they want to be extremely conservative when it comes to balance sheet management. And I think in part probably has to do with what Elon went through in Great Recession in 2008. And, we all heard this. If you have read his book or the biography or listened to his stories in the past, where he talks about how he had to kind of divvy up. He said he got like $40 million in net from the sale of PayPal, and then he said 20 million I'll keep to myself, 20 million I divvy up between SpaceX and Tesla's 10 each. But then in Great Recession, he had to put in the rest of the money to save both of the companies. Otherwise, it was going to be one or the other. And he said, well, I can't let anyone go. They're like my children. So he put the rest of the money in to keep the companies going. And I think Jurvetson, I maybe mispronounced his name there, but he says that's like the greatest thing that he's ever seen. So anyway, so I think that kind of leaves an impression on someone's psyche, and that's probably part of the reason why Tesla is so conservative when it comes to balance sheet management. And this is one of those things. So you look at Rivian, 42%, BMW, 70-80%, Tesla, close to 0%. All right, let's continue with the next.
Thank you. And our next question coming from the line of Dan Levy with Barclays. Your line is now open.
Hi, good evening. Thank you for taking the questions. I want to start and just follow up maybe a bit on Emmanuel's question. And just to decompose the third quarter COGS per unit, it was roughly $127,000 if you backed out the cost of revenue initiatives. But recognizing that there were inefficiencies on the volume, on the supplier side, maybe what is a more clean way to look at your current COGS per unit? And then into 2025, if you could maybe just decompose some of the pieces on the COGS per unit that get better, and specifically the cadence of material cost benefits, how that layers in.
Thanks, Dan, for the question. Yeah, this is, of course, something we spend a tremendous amount of time focusing on. And, the third quarter it's a hard quarter to look through all the noise with the ramp up and bring up of our Gen 2 platform. As Claire said, a number of supply relationships that either changed or ended and replaced with new supply relationships. As I said, we replaced about 50% of the bill of materials as measured by cost. And then, of course, the supply interruption that did halt production for some time and overall lowered the amount of vehicles we were able to produce in the quarter had some impacts. So you look through all that noise, and I think the important thing to note is if you were to look at material costs in this quarter, in Q4, and you were to compare that to our material costs in the vehicle in Q1 of this year, the Q4 material cost is going to be 20%. We project to be 20% lower than what we saw in Q1. So we're making real meaningful progress in terms of lowering our bill of materials, lowering our cost structure. And in a similar fashion, we're also driving efficiency into how we're running the plant. So the hours per unit that we build is coming down. We're driving more quality into the vehicles. So there's just the flow of the plant is running smoother. But it's really hard to see through all the different elements that made up Q3. And so we actually talked about this a lot. How do we communicate the progress we're making despite the fact that Q3 makes it hard to see? And I think, in short, that one of the most important things to call out here is that we're continuing to guide on Q4 to a positive gross margin overall. With that said, I do want to just invite Javier to have a few comments here. He's joined the team now for a couple of months. Him and I, and along with the rest of the leadership team, have been working really closely together, not just on the production of R1 and the continued progress towards positive margin there, but very importantly on the R2 program, and that's both in terms of the plant but also the supply chain.
Thank you, RJ. Indeed, it's a big focus currently is in improving performance, implementing lean acceleration, if I may call it that way, compressing the value streams, empowering the shop, so unleashing the potential of all of our members, team leaders, group leaders. And we have started recently with very promising results, and really was visiting the line this morning, and I'm very pleased to see how people are engaged in improving performance. We are as well robustifying our Rivian industrial operating system, or integrated operating system, all our lean principles, and again, accelerating their implementation. And when it comes to the way of working in the teams, enhancing an end-to-end cross-functional view and collaboration. The big priorities for that performance is improving in the short term those results. But what's more important is to prepare the plant for landing R2 appropriately at the right levels of quality, cost, and with the right delivery times.
Great. That's helpful. Maybe just if you could remind us on the benefits actually from stronger operations in 25, how much runway there is to drive the COGS per unit down.
Sure. As we think about 2025, one of the core benefits that we'll have is having the Gen 2 in production for the entirety of the year relative to what we had over the course of 2024. As RJ alluded to, 2024 is also a little bit noisy, just given the shutdown that we had to introduce the Gen 2 into the line and ramp up from a production standpoint. So as we look ahead, Javier and team, now have the opportunity to really drive many of those core lean manufacturing principles to drive an overall focus around operational efficiency within our manufacturing facility here in Normal, and ensure we're ready for R2, which is coming next in 2026. We will still have a shutdown as part of our production cadence in 2025. That'll be in the second half of the year, of just over a month of shutdown there to do a number of work and a lot of work on many of the shared shops, and specifically our paint shop, to make sure that we're ready for R2's start of production.
Thank you. If I could just squeeze in one more on Volkswagen, we've seen the Scout announcement, and it's using the joint electrical architecture. Maybe you could just, and I know we're waiting for the JV to be closed, but remind us of sort of where the collaboration currently stands?
Yeah, as I said, we're excited about our partnership with Volkswagen and looking forward to being able to support developing really compelling products across a portfolio of brands and markets. As it stands today, we've built a demonstrator essentially that is a driving vehicle that utilizes our electrical architecture, our ECU topology, our software stack, and it's incredibly encouraging and exciting to our teams on both the Rivian side and the Volkswagen Group side. And in terms of which products our technology is going to go into and in what cadence, that's not been announced yet. But of course, the nature of the deal and the scale of this partnership in this deal is such that our technology be seen across many different products and brands within the Volkswagen Group family.
Thank you. Now, next question coming from the line of Mark Delaney with Goldman Sachs. Your line is now open.
Yes, good afternoon. Thanks very much for taking my question. I think 2024 production guidance implies that production in the fourth quarter will be a little over 11,000 units or roughly 865 vehicles per week. Maybe you can help us better understand where Rivian currently stands. And I ask to better contextualize where you stand with the supply constraint with the Enduro motor.
Thank you, Mark, for your question. We are working. We have been working in the last weeks with that specific constraint. I would say that it's a short-term constraint, and the teams have demonstrated a great, enormous sense of urgency, gathering together with the supplier, working cross-functionally, constrained teams on site. And what's more important is that we are now ramping up a new capacity in record time. The last weeks have been very promising, and we see that we are in the right trend to recover the right capacity. Really, really promising. So we think that that problem, or I think, really think that that problem will be over in the very next weeks.
Thank you for that color. My second question was around the regulatory credits. Claire, you said you now expect $300 million for this year. I had thought it was closer to $200 million as an outlook for 2024. Maybe help us better understand what's leading to the upside relative to the prior view. Thank you.
Sure, Mark. As we've gone throughout the course of this year, we have seen an increase in the underlying value of the regulatory credits that we've been selling to many of the OEM counterparties across the board, as well as the opportunity to sell deeper into the overall red credit areas of focus for our core team. This is a highly complex puzzle as our team manages our credit portfolio relative to the needs of other OEMs on a state by state basis as a whole. And so this is just a demonstration of the progress that our team has been able to make to achieve this great outcome of being able to bring in $300 million of value to Rivian through the sale of these regulatory credits.
All right, so that's more color on the regulatory credits. This is obviously something that some analysts adjust out. But I think this is hard cash for Rivian and Tesla, and it's going to continue to be very valuable in the future. Tesla. So I pulled up the number as they were talking. In Q2, Tesla sold $890 million of regulatory credits. In Q3, Tesla sold $739 million of credits, and I would expect this number to continue to increase and turn into $1 billion a quarter. And so Rivian seems to be benefiting from that too. And the analysts asked about that. And we flagged it earlier as we were discussing earlier comments as well. So it's becoming a very material number for both companies. And I think analysts will continue to kind of dig into this a little bit more. Jacob, any comments on that?
None.
Okay. So she says, As we've gone throughout the course of this year, we have seen an increase in the underlying value of the regulated credits that we've been selling to many OEM counterparties across the board. Okay, so in the past, there was an oversupply of these credits, and I think the max value of a ZEV credit is like $5,000, but Tesla was selling them for like $1,000, $2,000 per credit because of the oversupply. So maybe that as companies kind of switch back, cancel their EV programs, cancel their battery factories, and switch back to producing hybrids, they don't see demand for their EVs. They still have to meet these credit requirements, quotas. So they're going to be maybe turning to Rivian and Tesla to buy these credits. So we'll see. I think the number for Rivian seems to be $100 million a quarter, and for Tesla, $1 billion a quarter, ballpark figure. Okay, let's continue.
Thank you. Our next question coming from the line of Joseph Spak with UBS. Your line is now open.
Thank you very much. Claire, just in talking about 2025 a little bit, a couple times on this call, and you mentioned still that gross profit positive target. You again just sort of mentioned, some downtime later in the year. So I just to be clear, when you say gross profit positive, is that for the full year, at some point of the year? Is it like on the R1 vehicle, like X something for R2? And I guess just related to the regulatory credit question, like how do we think about the cadence of that? Like, do you have any recourse in when you recognize that revenue?
Sure, Joe. As we look at 2025 overall, as you rightfully pointed out, we will have quarterly impacts. So we don't expect that every quarter in 2025 will be positive gross profit in its own right. Our target is to be positive for the year in its entirety. And so as we think about some of the relative impacts that we'll have, next year as a whole, some of that will be driven by the lumpiness of the recognition of our regulatory credits as well, that are certainly an enabler of that path to positive gross profit in 2025 in aggregate. And so as we look out into the future, we do have an understanding of timing needs of many of the counterparties that we're working with. In some cases, the timing of regulatory credit recognition is related to government agencies as well. So some of it is a little bit up for, understanding the exact, timelines that will achieve it. But that's, our current view, and as we think about the overall cadence of recognition of those credits.
Okay, so there you go. This is exactly what we talked about earlier, that these regulatory credits are lumpy. In Q3, they recognize very little. Maybe Q4, they'll have a bump. But more importantly, what they're saying here is, she says, we don't expect every quarter in 2025 will be positive gross profit in its own right. So even if they get to Q4 gross profit positive, they're going to probably switch back to gross profit negative in Q1, which is a seasonally weak quarter. And that's partly, she says, partly because of the regulatory credits, which means regulatory credits will play a large role probably in Q4 in getting up to gross profit positive. And then they target to be positive for the year for 2025 in its entirety on the gross profit level. And then they said earlier, RJ said, or I think it was the CFO, Claire, said they expect R2 to bring them to free cash flow positive, but that's like several years out. So yeah, interesting. All right, let's continue.
Oh, before we do, I gotta go pick up the wife. This has been absolutely fun. For all of you that are listening, go ahead and hit that like, hit that subscribe button. And I want to continue to learn more. I definitely need to improve on my knowledge. So please keep this space alive so I can do that. Everybody, Yaman, thank you. I appreciate it, man.
Okay, thank you. We'll continue. We have another 20 minutes or so left on the earnings call. We're going to continue. And then if you have any comments, questions, leave it in the live chat. Steve Utsi asks, how much cash do you expect Rivian to burn in 2025? I think it's going to be, again, billions of dollars in 2025 cash burn. So we'll see. And then any other, Sean says this is a good idea. Yeah, I would expect these watch parties to continue with earnings calls and also with technology events by Tesla, like the Robot Day. We can rewatch Autonomy Day. We can rewatch, and every time we watch, we improve our understanding of technical aspect of Tesla's business, and then that informs our discussions in Tesla Live. Increase the quality of discussions, the questions, that the answers, etc. So I highly encourage everyone to attend these watch parties. If you don't get a chance to listen to it live, and you can watch the recording on X or YouTube, and just let me know if you can't find them, and I'll guide you to it. All right, let's continue with the Rivian call.
But just at a high level, excluding maybe some of the agency stuff, like you recognize revenue when someone buys it from you. Like you can't recognize it on an agreement to buy it from you.
Right. It's not on an agreement. It's when we transfer the credits to that counterparty.
Okay. The second question, just I apologize. I joined a little late, right, as you were saying this, but I thought I heard you say van production will be up in the fourth quarter. Is that deliveries too, or are you building some inventory maybe in advance of some actions in next year? Because I thought in the past you would mention that Amazon doesn't really like to take a lot of vans in the fourth quarter. So did something change with the cadence there?
Yeah, as I mentioned in my prepared remarks, we're increasing our production of both vans as well as tri-motors in the fourth quarter. So increasing production as well as deliveries of those units, because both of those variants only require one Enduro motor. And so from an operational efficiency standpoint, that was the best way for us to increase or maximize our overall production for the year in aggregate. So I would say we do certainly expect that there would be additional Amazon van sales in the fourth quarter of this year.
Thank you. Now, next question coming from the line of.
So we mentioned it earlier in the call. Last year, Rivian said Amazon does not take van deliveries in the fourth quarter because of the busy season around Christmas and the holidays. But this year, they're saying Amazon will increase its orders and deliveries will increase, and that will contribute to a gross profit positivity in Q4. We flagged it as a interesting comment from management. This completely contradicts what they said last year. People in live chat mentioned the same thing later on in this call. And then now we see an analyst asking the question. So on all fronts, everybody understands that this was just last year's comment was interesting.
George Gianarikas with Canaccord Genuity. Your line is open.
Hi, good afternoon, and thank you for taking my questions. I just want to piggyback on a previous question around the relationship with Volkswagen and the Scout vehicle. From what we understood about the relationship, it had to do with electrical and software, but the car looks a lot like an R1. And so to what extent can we expect there to be sort of a similar lineup from Volkswagen with regard to Rivian, and how closely will you be cooperating on aesthetics as well as engineering? Thank you.
Yeah, thanks, George. The joint venture, what it encapsulates is our electrical architecture, our ECUs, and the software that's running on those ECUs. And it's really important to recognize that doesn't mean the UI frameworks, the way the digital screens inside the vehicle look, the number of screens, the shape of the screens, but really the underlying software. And that's going to, that platform, our platform is going to be used across a wide range of products and brands. And each of those products and brands will have decisions around what the vehicle itself looks like, which of course doesn't link to the software, to the electronics, but they'll also have decisions around what the UI looks like inside the vehicle and their overall digital design and design framework. So, with regards to our role in any design decisions, those decisions remain with the brands, of course, within Volkswagen Group.
Thank you. And maybe as a follow-up, just any update on commercial vehicle traction in the marketplace and when we could expect additional customers to ramp volumes? Thank you very much.
As we've said for a while now, the sales cycle on these larger corporate commercial fleets takes some time. It's not just the purchase of the vehicles or the decision on vehicles, but it often means changes to the standard operating procedure for the fleet operator. It requires charging infrastructure, which often is not simple because the sites that they're operating out of may not have been designed for that level of power, that level of energy. And so, with that said, we are starting to see the beginnings of the efforts that we've had over the last year to put those in place, and we'll start to see more of that in 2025. And this is a focus for the team. And we're super excited about seeing our vans out in the world with different logos and different brands on them as different fleets start their journey towards electrification.
Thank you. And our next question coming from the line of Tom Narayan with RBC Capital. Your line is now open.
Hi, thanks for taking the question. Sorry, one more on regulatory credit. So if I look at the Q3 gross profit at the negative 392, I believe the 300 million of that, I think 275 hits in Q4 alone. I think you did 25 year to date. That would imply like 117 million benefit in Q4. Volumes were depressed in Q3, so they're coming back in Q4. That should be a benefit, a big piece, I would think, of that 117. It just feels like the sequential bridge between Q3 to Q4 on cost improvement sequentially might not be as significant. It'd just be helpful, Claire, to just see what the cost improvement piece of that bridge is. If you could quantify that, that'd be really helpful. Thanks.
Sure, Tom. We don't give specifics, but as we think about the core drivers beyond the revenue-related ones that we talked about, there is going to be significant improvement in underlying average selling prices as we start to sell through additional tri-motors in the quarter. As I mentioned previously as well, we ended the pre-order holder early pricing, and so that would be a natural boost overall as we think about more full price sales in the fourth quarter in aggregate. And then as we look at the underlying cost structure as a whole, embedded in our production guidance is slightly below our Q3 level as we think about the underlying fixed cost absorption. So where we're seeing the benefits there, as I mentioned, are really a step down in depreciation. We also expect to see our LCNRV and firm purchase commitment levels coming down, and then we'll see continued progress on a variable cost per unit basis. So as RJ highlighted previously as well, there's a bit of noise that you see in the Q3 numbers. So Q4 will be more representative of our go forward, launching off point into 2025, where we anticipate seeing, further progress across, each of the three core drivers of revenue per unit, variable cost per unit, and fixed cost per unit improvements.
Got it. My follow-up, RJ, on the R2, I believe the $45,000 price.
So just to put that in perspective, she basically said they expect some ASP increase. So analysts said, okay, you're telling all these things, but if you kind of piece it apart, the fundamental improvements in gross profit isn't going to be significant from the cost reductions. You have credit sales coming up. She also pointed out some non-cash expense improvements. But from a unit cost basis perspective, the analyst pointed out that it doesn't appear to be significant. Can you give us some color? And she basically said, that's about right. She pointed to the non-cash stuff. And earlier in the call, Claire said that they don't expect every quarter in 2025 to be gross profit positive. So like this, like reading through these answers, listen to earnings call gives me even less hope of what Rivian will be able to accomplish, or the problems that Rivian will survive 2025. It's even less in my mind after this call than before. So let's continue. We have about 10 more minutes left.
Variety is the one that's not the 300-mile range one. It might be below. Just wondering how competitive that would be. A $45,000 under 300-mile range vehicle in 2026. The competitive environment seems to be, we have GM with the, Equinox at sub 30,000 with 300 plus miles of range. How does that compete? Is it a different demographic perhaps that makes it, different features beyond just battery range? Just love to hear how the competitive environment, shakes out with that product at that range, at that price. Thanks.
Yeah, thanks, Tom, for the question on R2. We love talking about R2. We're super excited about it. Just to clarify, the $45,000 starting price for R2 corresponds to a lower performance spec on the vehicle relative to what's possible at a platform level, but the range on that variant is still over 300 miles. So it's a 300-mile, what we say 300 plus miles of range, but on a lower performance spec and with some of the content levels on the interior slightly different than the top spec variants. And, we've spent a lot of time looking at this relative to what else is in the market. And one of the biggest unlocks, we believe, for overall demand of EVs and the path towards ultimately 100% of new vehicle sales being electric is the need for a lot of customer choice and a lot more choice than we have today. And there are very, very few compelling options in that sub $50,000 price range. And, we believe R2 is going to be an important product for giving customers choice. That's a unique form factor, unique performance and brand and product attributes. And having spent a lot of time in and around the vehicle, I can say I've never been as excited as I am for a product as I am for R2.
Thank you. And our next question coming from the lineup, Jake Scholl with BNP Paribas. The line is now open.
Hi, everybody. On the revenue per unit increase for the fourth quarter, I assume this excludes the $275 million in regulatory credits. Is the increase a year-over-year reference or compared to the first quarter? Can you just remind us? And then just to echo, maybe part of Adam's first question, what's the level of visibility in your order book for such a sizable ASP step up? And would the increase in EDV deliveries for the fourth quarter, weigh on your ASP? So if you could help to mention what that EDV growth is, might look like, and whether sequentially or year-over-year, that'd be great as well. Thanks.
Sure. As we think about the revenue per unit increase in the fourth quarter, as you rightfully called out, we see an increase in R1's average selling price, which is partially offset by an increase in the sale of commercial vans in the fourth quarter. Those comments are relative to what we experienced in the third quarter of this year as a whole. And I would say as we look back to last year in aggregate, in Q4, you did see a much lower, sort of 8% of revenue being represented by commercial vans. We'll see that just over, about closer to the 25% level in Q4 of this year in aggregate. So there will certainly be some puts and takes there, but that's really the foundational drivers as we think about overall ASP. But on a blended average unit, we'll still see relative to Q3 an increase from an average selling price standpoint.
Got it. Super helpful. And then just go ahead. Do you have anything else to say?
No, I was just going to comment a little bit on order bank or order book visibility as a whole. Our teams from a go-to-market standpoint are, continuing to drive and push for, more consumers to get behind the wheel of our vehicles. We saw that demonstrated by the 20% increase in our demo drives that we had in Q3 relative to Q2 levels. And we're continuing to drive, brand awareness as a whole to build up more and more interest in Rivian and have that interest translate into orders.
Thank you. And then just on the VW JV, is it expected to close before year-end? My apologies if I miss confirmation or clarity on that. And just associated with the JV, I believe there were going to be certain milestone achievements associated with VW's additional funding tranches. So can you provide any color at all on just what the context of those milestones might entail? Thanks.
Hi, Jake. The Volkswagen joint venture is we expect it to fully close certainly before the end of Q4. And a lot of the work that's gone into defining such a significant and scaled partnership is played out over the last few months, and part of that is some of the KPIs, if you will, or the targets that we're setting for ourselves. And so we've worked really closely with the team at Volkswagen Group to define those, and we're very comfortable with those in terms of milestones that unlock certain portions of the financing associated with the deal.
Thank you. And our next question coming from the lineup.
Yeah, so from that, we understand that in Q4, Rivian will try to get to gross profit positive with ASP increases. The response to analyst question reveals that Rivian expects a huge increase in van deliveries in Q4 to Amazon. So that's going to be part of it. And ZEV regulated credit sales will be another big chunk of it if they achieve it. So, and then these are both lumpy. Regulated credit sales and van sales deliveries are both lumpy. So that explains why Rivian doesn't expect 2025 every quarter in 2025 to be gross profit positive. So it kind of all adds up now with all that commentary to analyst questions. So let's continue.
Edison Yu with Deutsche Bank. Your line is now open.
Hi, thank you so much. This is Winnie Dong on for Edison. You guys have mentioned that 85% of the sourcing of all-true BOM is already done. Could the potential tariffs that take place under the new administration play a role in the cost target, or have you sort of designed the sourcing such that it wouldn't matter which administration wins the election this past week?
The R2 sourcing process is something we've looked at very strategically and certainly have contemplated even prior to the election, just what the impact would be should the overall approach to tariffs change. And so a lot of our focus has been on sourcing suppliers that are not going to be subject to large tariffs, and in places where we have source suppliers that are overseas that could be subject to changes in tariff structure, designed the contracts and designed the relationships in such a way that we're not carrying much of the risk. Now, with that said, there's a lot of policy elements here that are in play, and we're watching it very closely. I think what's going to be interesting is how far this reaches into the upstream supply chain. So as we think about raw materials, that's something that every manufacturer, certainly ourselves included, are thinking about.
Got it. That's very helpful. And then I think in Q3 we did see sort of like a meaningful decline in OpEx sequentially. Can you remind us if there was any sort of extra reductions that flew through versus initial expectation, and then how sustainable that is and how we should be thinking about that for 2025? Thanks.
Sure. As we think about the underlying reductions that we've seen in our cash operating expenses, we were able to bring that level to about $599 million for Q3, which is a significant step down from where we were in the first half of the year. We've talked about the second half as being lower than the first half in aggregate, which will unlock our ability to be able to have lower cash operating expenses in 2024 relative to what we had in 2023. And this is the collective efforts of many members of the Rivian team across the company, continuing to focus on driving efficiency so that we can strategically invest in the most critical areas of the business as we think about many of our differentiated technology investments, as we think about the continued rollout of our service centers and spaces to support our go-to-market efforts and strategy. And so very much proud of the work that our team has done to enable this level of improvement. We do expect, as we look to Q4, that we will see an uptick in terms of our spend. That's really driven by additional R2-related spend that we'll begin to see from an R&D standpoint, and then the ongoing build-out of our go-to-market strategy, which will have some limited growth in our SG&A line item as well.
Thank you. And our next question coming from the line of Alex Potter with Piper Sandler. Your line is now open.
Perfect. Thanks. So I had a question on the Volkswagen relationship. There's obviously been, I don't know, a fair amount of intrigue in the media regarding headcount reductions and restructuring and plant closures and things going on at Volkswagen. And I just wanted to, I guess, get some clarity on whether any of the teams that you've been working with may or may not be impacted. I don't know. Obviously, you maybe can't put words in their mouth, but has this impacted you in any way, or are there ways that it could potentially impact you, looking ahead?
Alex, thanks for the question. The nature of what we're building with our Volkswagen relationship and the partnership that's been designed provides a really efficient way for them to deploy advanced technology. So it's a zonal architecture, which brings massive consolidation to the ECU topology, dramatically simplifies not only the software architecture, but also the electrical architecture as it pertains to the vehicle harness as well. So ultimately, this is just as it is within Rivian, this is going to drive structural cost advantages into the business. And, this is, I think, a core reason as to why this partnership and this deal has happened. So I think in the context of driving greater efficiency into their business, what we're building with the joint venture absolutely aligns with that and is really important for not only creating products that are really compelling to customers, but to create those products in ways that are highly cost efficient.
Okay, very good. And then maybe lastly, there was a fair amount of verbiage in the shareholder letter on Connect Plus, streaming apps and things of this nature. Is this, it sounds sort of compelling. It sounds like the take rates are pretty high amongst people who have been trying it. Is this something that, is modelable, something that investors should be including in their own forecasting, or is it not quite material enough to call that out? Thanks.
Yeah, this is sort of one of the big questions I think being asked broadly around the automotive industry is, to what level do future services show up as recurring revenue, or do they show up first, on price on the front end? And in this case, the Connect Plus, what that's relating to is there is a variable cost associated with providing the services. So the data costs to, let's say, stream music or to have a Wi-Fi hotspot are non-zero. And so this reflects us capturing that in a bundled package that brings along with it not just the price that covers the cost for us to be providing the connectivity, but also some additional features. And we're watching this very closely, and in particular thinking about it in the context of the growth of our autonomous platform and what that provides in terms of new features, new capabilities, and how to appropriately charge for that. And I think it's too early to tell
for us as an industry to say whether customers are going to prefer to pay for things up front or whether they'll pay, like to pay for them over time. And the way we've at least modeled it internally is we've looked at the likely existence of both models, where you'll have some customers that would prefer to pay up front and others that would rather pay on a more variabilized basis. We sort of look at it with some indifference, meaning is ultimately it's going to get captured in the price of the vehicle, but it can be captured in a multitude of different ways.
So that's an interesting comment right there from RJ about Connect Plus, to a response to a question by Alex Potter. So RJ is pointing out to the non-zero variable cost of providing these services, and Connect Plus in Rivian's case is about $15 a month. And earlier in this stream, we kind of did back of the envelope calculation. It should be about a few $1 million of revenue, and with that variable cost, the incremental profit to the bottom line is going to be very little. And so I wouldn't expect that to be material. But the accounting, what he kind of mentioned around variable costs, is I think something that we can take away from this call and think about how that applies to Tesla in Tesla Live next week. So we can talk about that in Tesla Live next week. So let's continue. We have one or two more questions, and then we're done with this earnings call. I hope you all liked the Rivian earnings call watch party. I see there's about 1,000 of you between X and YouTube right now. Please take a moment to repost, like the YouTube live stream, help us grow, subscribe on the channel. We're trying to get to 10,000 subscribers by year end. And with your help, I think we're going to get there. So thank you very much for all the people in the live chat as well for your questions. Just one more question, one or two more questions, and then we'll call it a day.
Thank you. One moment for our next question. And our next question coming from the line of Mike Shlisky with D.A. Davidson. Your line is now open.
Yes, hi. Thanks for taking my question. I guess given some of the challenges you mentioned, the consumer challenges you had mentioned earlier, just with some of the demand impact that's been having, I've heard about these kind of new variants that might have higher price, and you've got a higher price assumption in the fourth quarter. But I'm curious if you're seeing on a like-for-like basis, when people are making orders, are they trying to look at cheaper options or maybe fewer features? Has that been a trend at all?
It's important to recognize there's really a broad spectrum of customers. And because of that, we've launched now 3 different powertrain configurations. So we have a dual motor, a tri-motor, and in 2025, we'll be launching our updates to the quad motor. And then we have a couple of different battery pack sizes. We have a standard, of large, and what we call our max pack. And effectively, that's us trying to populate the demand curve, where we know some customers want the best thing they can possibly buy. So they're willing to pay to get the 2.5 second 0 to 60 and 400 miles of range, and others are going to be more price sensitive. I think what Claire's referring to and what we're excited about is just the level of customer excitement we're seeing for the tri and for our quad. And that, of course, is positive for us from a margin point of view. But these are hard things. You can imagine we tried to model this, predict this, and these are hard things to accurately predict. And to now have the tri in the market and to see how customers are reacting to it, see when we put a tri-motor variant into our shop, how quickly it's there for but a moment, it disappears very quickly. That the level of excitement and demand for that vehicle is high. And so looking into 2025, our next generation quad motor vehicle is really, it's just exceptional. It's the first gen quad was great, but this is a whole nother level. It's a vehicle that can do the quarter mile in less than 10.5 seconds. It's incredibly smooth and refined. It can go into almost any imaginable off-road environment, and you can use it as an everyday driver while in conserve mode getting close to 400 miles of range. So it's just a very unique combination of attributes, and of course, it'll be priced as such and therefore drive a healthy margin to the business. So these are, this is the reason we have this different topology of motor battery combination and trim combinations to allow us to sell into multiple different customer types.
Thank you. And I'm showing no further questions. I will now turn the call back over to RJ Scaringe for any closing remarks.
Thanks everybody for joining us on the call today. As you heard me say in our opening remarks, this is a challenging quarter with some of the production interruptions we had around supply and some of the nuanced complexities associated with transitioning into the Gen 2 vehicle and ramping our Gen 2 R1. But we are incredibly excited about what lies ahead, not just with Q4, but thinking into 2025 and very importantly into 2026. The excitement around the R2 program, both internally and externally, but from customers, but also just with the teams that are developing the product and preparing it for launch is contagious internally. And every time I'm in or around it, I think to myself, I wish this was available today. So we are fully embodying that and doing everything we can to get that vehicle to market, both on time, but as Javier said, also really excited about how we're maintaining the program around its cost targets, which is such a significant focus for us with that program. And with that, it's exciting to have Javier join us on this call today. He's been a great partner to me as we're continuing to build.
All right. So that's it. We're going to just highlight two comments in the live chat. One from Steven UC. Steven says, on the earnings front, it appears at first glance that many items are one-time non-cash expenses. On the free cash flow line, there isn't a meaningful improvement from Q3. And I agree with that comment. We also mentioned similar previously on this call. So, and then I think Marty summarizes this entire thing well. Marty says, looks like Rivian will get profitable on paper in Q4. This is gross profit profitable. Okay, not operating profit or net income profit, gross profit. On paper in Q4 in order to get favorable rates on the capital raise, which obviously involves maybe qualifying for this additional money from Volkswagen. That's my guess. We've seen this game before in other companies, and I agree. And one important takeaway again from this call is that Rivian does not expect gross profitable to continue every quarter going forward in 2025. So this is very different from what Tesla did. Okay, Tesla in 2012, when ramping the Model S, there was one quarter Tesla had negative gross profit in Q3 2012. In its entire publicly traded history, Tesla had only one quarter where gross profit was negative in Q3 2012. Okay, in Q4 it turned positive, and then in Q1 2013, Tesla turned bottom line profitable as well. Rivian hasn't been able to turn gross profit positive for the last several years since their IPO. And in Q4, there's a possibility that they may show, due to mostly one-time items, really, they may show a positive gross profit. But even the management doesn't expect that to continue throughout every quarter in 2025. And what really matters to the stock is bottom line profitability. And after this call, I continue to expect Rivian to, I hope they succeed. But I think there's a reason why the stock market didn't react positively to the reiteration of the Q4 gross profit expectation. And that's because I think the stock market has already priced in that this company is not really a going concern beyond next few quarters. All right, with that, thank you very much. I hope you enjoyed this watch party. Hit like, subscribe, and I will chat with you all next time. Take care.